This is Duke University.
Very important. They should first and foremost take a deep breath. Then remember that this is only a period of time. They've been opening those statements probably for years. And in the prior years it was going up, they felt very comfortable with that. Now it's gone down for a period of time, so they're feeling a level of discomfort. This too will pass. So they have to put it into perspective. If they're thinking long term, and they're thinking years before retirement, this may be an opportunity to buy an asset class cheaper than what they were buying before. It is my opinion that individuals should continue to make investments or contributions to their account. They may want to change where they contribute those dollars, but they should not cease to make contributions to their retirement account. I think it's very important to think long term. Just because we are fundamentally having a changed environment today doesn't mean that tomorrow or 2 years from now we won't be back to an environment which may be very conducive to investing. So you should be thinking long term here. Well, you know, we keep talking at TIAA-CREF about education. It's very important for them to talk to one of our advisors. We have advisors that they can talk to, and those advisors will help them make the decision. I talk about something called sleep point. Everybody's sleep point is different. JP Morgan came up with the term sleep point. He said, what's your sleep point when someone asked him in 1929 if he should invest all his money in stocks? If you understand your sleep point, that's your risk tolerance, you'll understand how much you feel comfortable investing in equities, fixed income, and real estate. There's been a lot of studies done that show that people should take more risk when they're 20 than when they're 50. And the reason for that is twofold. And risk can be defined as equities. That's how you had defined it. I'll just define it as risk, okay? Because in different periods, different asset classes will have higher risk and potentially higher returns. But the reason a 20-year-old would want to take more risk than a 50-year-old is because they have a longer time frame and they could absorb losses if they should incur. And secondly, future earnings stream for a 20-year-old should increase, so that their earnings alone should offset any risks or losses they may take in the portfolio. Someone in their 50s or 60s, let's say 60, is approaching a retirement age. Hopefully they've amassed the wealth that they anticipated by that period of time. They may wish to take some of that risk off the table and to annuitize, that is to buy an annuity with a portion of their retirement income so that that's a guarantee that they'll have future flow. But they need also to stay into risky assets. They can't move everything into fixed income assets or annuitize because inflation will come back and they will live a lot longer than they anticipate, and hence they need to make sure that they have some offset to inflationary tendencies in the economy. Most important, think long term. They should have a long-term plan. They should continue to do contributions. They may not continue to do their contributions into a specific asset class, but they should continue to do contribution. And they continue to dollar cost average. I mean, dollar cost averaging has been very much undersold. When you dollar cost average, what you're doing is you're minimizing the volatility within your portfolio over long periods of time.